Hello everyone, hope you are good and be happy always. Once again, welcome to Shachi's Academy, and today we'll discuss cost analysis or concept of cost. See, in managerial economics, cost concept is really very important, and in business as well. Why? Because if you have to do any business or if you're planning to do any business, you have to think about the capital or the money. You'll have to buy raw material, you'll have to set up your plant, you'll have to purchase machineries to set up them in your plant and produce. And you need n number of resources for your production and other facilities as well. For all these things, you need to spend money. And money spent on all these overheads is called cost. It is very simple. So what is cost? Expenditure done on production activities for doing any type of business is your cost. Okay. So let's discuss this concept in detail now. What is cost analysis? Cost analysis refers to the study of behavior of cost in relation to one or more production criteria, namely size of output, scale of operations, prices of factors of production, and other relevant economic variables. See, when we do business, we have to involve ourselves in n number of activities, and all these activities need money for their purchase or operation. Take for example size of output. If you want to produce something, so larger the amount of that production, larger will be the cost or higher will be the cost, because we need to spend more money. For example, if we are producing 10 burgers or we have to produce only 10 packets of biscuit or 10 packets of bread, that means we won't have to spend more amount of money. But if we have to produce 1000 packets of biscuit or bread, we'll have to spend more money or the amount spent will increase. That means output determines what will be your cost, and cost changes in relation to your output. Then scale of operation, that means what is the amount you will produce or what will be the size of your factory or the firm you are operating. That also determines your cost or the money spent on the production activities. Then we have prices of factors of production. What are different factors of production? That is land, labor, capital, then your wages of people, raw material, etc. Then if these things are costlier, if they demand more price, if the cost price is high, then you have to spend more on them. Take for example, if you need a technician or you need an engineer for operating certain type of specific machine that you have imported from some other nation. For that, you will have to hire a person who is well versed or who is expert in that machine, operation of that machine, and that person may demand higher salary, which may be double what you see in your normal market of wages or people. Okay, so here your expenditure or cost will increase because you will have to spend more on the salary of that engineer or expert. Then other relevant economic variables are there. Then advertisement is there. You always see advertisements whenever you play YouTube videos or you go to cinema halls, you watch advertisement over there. So to make your commodity popular, to sell it in more amount or in larger amounts, you have to advertise your commodity, and for that advertisement you have to spend money, of course, and that money also is included in your cost only. So higher the advertisement, higher the scale or level of advertisement. For example, if you take some local that means model for your advertisement, then that will cost you less. But if you are hiring or asking Ashura to play in your ad or act in your ad, then the amount for that advertisement will increase significantly. That means higher the level or higher the quality of advertisement, that means in regional level you will have to spend less, but at national or international level of advertisement you will have to spend more. So cost will increase accordingly. Then transportation costs are there, market disruptions, unforeseen circumstances like COVID-19, demonetization, all will cast impact on your cost, and they will increase or decrease according to the operations. Okay, then we know production analysis deals with physical aspects of production. That means in your production process, you are just looking at the quantities of input and output. What are inputs? Factors of production are inputs, and output is your finished product. But in your cost analysis, deals with your financial aspects of production. Okay, so production analysis deals with physical aspects and cost analysis deals with money aspects or monetary aspects or financial aspects, because we have to purchase everything over here and money is involved. That's why it is concerned with financial aspects. Clear? Then it is important for all business operations and decisions. Why? Because without money you can't do any business, and you have to purchase or you have to spend money, you have to do expenditure on different overheads to do your business. So without cost analysis you can't proceed on any type of business or involved in any type of business activity. Then what is the cost concept? Cost is the total of all expenses. That means whatever expenditure you do on all the overheads of business in your production activities, maybe purchasing your raw material, it may be your hiring your labor, that means giving salaries, involving salaried people or wage people or casual labor in your production process, all involve expenses. And cost is what? It is total of all expenses or aggregation of all expenses in producing and selling any commodity. What is involved in selling expenditure? That is advertisement cost, commission to the retailers, commission to your sellers, etc. is involved over in selling cost. Or service, the producer has to incur cost to earn revenues. That means if you want to do business, if you want to earn profit, if you want to earn revenue in general, then you have to involve yourself in cost analysis or you have to incur cost for production. Then the cost concept states that all accounts are recorded in the book of accounts at their purchase price. That means a producer, when he involves himself in business, he has to purchase something from the market, but he purchases raw material. He does not purchase finished products. That means here the market price is not involved, but here the purchase price is involved. Okay. Then this excludes the, so it is expressed in money or monetary terms. Money or monetary terms means money is involved, that of course it is monetary or financial terms or money terms. This includes the cost of acquisition, transportation and installation, but not at its market price. So here purchase price involved. What is difference between purchase price and market price? See, when producer buys commodity, he buys directly from the people who produce them. For example, if I have a bakery and I have to make a flour and just make bread, okay, so if I need flour, I may go directly to farmers and purchase wheat from them and make flour from them and then bread. I can manufacture bread. That means I am going directly to people who are manufacturing or producing that particular raw material. But consumers, they buy finished products from market. That means they need to go for market price and producer just purchases things on their purchase price or bargain price. For example, if I make burgers and I need tomato, I will go directly to the farmers or vendors who sell at wholesale prices. But a single consumer cannot go to wholesale vendors or to the farmers to purchase small quantity 1 kg of tomato. You won't be able to go to farming any farmer and purchase them. Okay, normally in general cases. Okay, then this includes the cost of, I have explained that then. The producer allows the outflow of money for the sale of product. For sale of product also, producer has to outflow. That means he has to give out money. He has to pay out money to people for sale of his commodity to earn revenue. After the sale of the commodity, the business gains an inflow of money. For example, if you produce certain commodity, for example, I produce bread in bakery. That is my favorite business. I have referred to this example in many of my classes. So I produce bread and I sell in the market. When I sell that produce in the market or the bread in the market, I earn revenue. So for earning revenue, I have to go for outflow of money, my money, and then when generation of revenue happens, then I get inflow of money and I get profit. Cost function, then we have to see that the cost function is defined as the functional correlation between output and the total cost. What is that? Here C is there. C depends on what? C depends basically on quantity of production or the product which you are doing business for. That means it depends directly on the amount of quantity. Okay, the quantity or the amount of commodities which you are producing. Where C is equal to cost of production, Q is equal to quantity of output and F is equal to functional relation. So here F stands for functional relationship and cost depends on your quantity. That means higher the quantity of production, higher will be the cost, and lower the quantity of production, lower will be the cost. That means when quantity of production decreases, cost decreases. While quantity of production increases, cost will also increase because you have to increase expenditure on different overheads of business. Then comes your explicit and implicit cost. What are they? Cost is aggregation of explicit cost and implicit cost. Explicit cost is nothing but the price that a producer pays for acquiring different commodities. That means in money terms. And implicit costs are nothing but cost of his own resources that he uses without cost. For example, when I purchase raw material from market for my sandwiches or burgers, that means I am paying money to people, I am paying money to wholesalers, I am paying money to retailers from which I am purchasing raw material. But if I am manufacturing those burgers in my own room, so in my own at my own home, I am not paying any rent of my own home or my building. That means I am not paying out money for rent of that particular room in which I am doing my business. That means I am using my own resources and the cost of that resource is not included over here. It's not clear. Okay, so that is implicit cost, or you can say it is hidden cost that we don't recognize and we don't pay directly. That means here explicit cost, first of all, an explicit cost is a direct expense. We pay directly to people. That is paid in money to others or creditors during the production of goods. When we buy certain things, when we buy machines, when we buy raw material, when we rent any room for our business, that means we are paying money to others. That is explicit cost. It refers to costs related to various factors used in the production of the commodities such as raw materials, labor, wages, packaging of that commodity which you have produced. Might have seen packaging of different types of snacks or biscuits. That is very clear. Then, and in transportation, they are also called accounting or actual costs. So here, your explicit costs are what? They are also known by the name of accounting or actual costs. Then, features. It determines the price of the commodity because we pay actual amount to people, we pay actual money to people. That means we know what is the cost that is involved in production of that particular commodity, and by adding them all, we can recognize or determine the price of that our commodity which we can sell in market. Then helps in computing the profit that could be earned. So when we just determine the price of a commodity, we sell that commodity in the market, we generate revenue, and after deducting your cost that you have incurred in the production, you gain profit. So what is profit? Profit is equal to your revenue minus cost. Okay. They are traceable nature. Why they are traceable? That means you can recognize them, you can compute them, and you can determine them. Why? Because they are expressed or they are recorded in your accounting books in money terms. They are clear. That means what is the amount of expenditure you have done on particular activity, that is recorded, and that's why they are traceable in nature. They are accurate and they are not hidden. They are traceable. That means they are accurate as well. Implicit cost. What are they? An implicit cost is the factor of production sacrificed by the producer for an alternative production. The opportunity foregone is the implicit cost. For example, we have two rooms, extra rooms in our house. We can either rent them out or use them for our own business of sandwich making or burger making. So when I am using my own resources for my own business, that means I am not including those costs, and that is my foregone opportunity of renting out my rooms to earn rent from them. That means if I have put those rooms on rent, I could have gained some rent on them, but now I am using those resources or my rooms for my own business. That means I am foregoing my opportunity of renting out those rooms and earning rent, and that is your opportunity cost. That means opportunity foregone is your opportunity cost of any production. or they are the costs which arise when certain inputs including factors are owned by the employer himself and employed in the production process. Alternatively, it is also called, see, for example, time is also a factor of production and money is also a factor of production. If I am using my own money and investing it for my own business, that too is your implicit cost. Why? Because I could have used that money for any other business, or for I could have deposited that money for FD, or I could have invested that money in mutual funds and earned. But I am using that money for doing my own business, and that is my own factor of production which I am using for my own business. When a producer uses his own resources for his own business, that too is known as implicit cost. These costs are also defined as the opportunity cost used in the various factors of production. Layman language, that means in your normal or general language, using own resources for business is called opportunity or implicit cost or opportunity cost over here. There is no outflow of money over here. What are the features? You don't pay anything to anyone. You are just using your own assets or your own money or your own house or building or your own machines for any business. That means you are not paying anything out to anyone. It includes an estimated value of the product added with the profit. So there is only estimation. For example, if I am using my own money, so there is only estimate that I could have earned this much amount of interest on that. But there is no clear cut estimation, or you can say we don't record these things in your account books. We don't keep a clear or fixed track of these things. The costs are not met by payments. We don't pay anything to anyone. We have made it clear previously. These costs are generally untraceable in nature. When we don't record anything in accounting books, when we don't pay anything to anyone, that means we are not recording them in your accounting books or log books, and that's why they are not traceable. They are generally estimated, but they can't be traced back or they can't be computed accurately. Examples of implicit cost: using a personal building for factory production and not renting it out to earn money. Okay, you are using your own house or your own building for your own factory. That means you are not renting out or earning money. That means you have foregone the opportunity of renting out for earning money. Then interest on capital invested by entrepreneur or businessman himself. So you have foregone the interest which you could have earned on your capital by investing somewhere else, but you are using that money for your own business. That means you have foregone or given up the opportunity for earning rent. Then the wages of salary of entrepreneur. If this is very good example, if you are an entrepreneur, you are doing some business, that means you can't work elsewhere. You could have been engaged in some job, you could have been a salaried person or earned salary, but you are doing your own business. That means you have given up a salary, a package of salary which you could have earned on monthly basis to do that business. That means what is the opportunity cost of doing this business of yours, current business? That is your salary which you could have earned in some other job if you could have been there. Then cost of personal vehicle used for transporting products for sale in the market. Cost of home AC used in production purposes. That means using your own assets for business purposes is known as implicit cost. Then different types of costs are accounting or actual cost, economic cost, opportunity cost, incremental cost and sunk cost, replacement cost and historical cost, direct or traceable cost and indirect or non-traceable cost, shutdown and abandonment cost, short run versus long run cost, and fixed and variable cost. We will explain all these costs one by one in detail in our video. So be there in continuation. Then accounting or actual cost. So first of all, we will discuss accounting or actual costs. What is accounting cost? It is the cost incurred by the firm in acquiring various inputs for production from outside suppliers. These are also called explicit costs, money costs or normal cost. That means here whatever money you invest in doing your business directly, you pay out to people, that is your what? That is accounting or actual cost. And this is exactly the explicit cost which we have previously explained. So you can write the same definition, but you have to just put this accounting cost there. Then for example, purchase of raw materials is there, Payment of wages is their rent on hired land or building, etc. are all included in your accounting or actual cost. Economic cost. Economic cost of production includes not only the accounting cost or explicit cost but also implicit cost. So here what is economic cost? That is simply the cost which we explained previously, that cost is what? It is explicit cost plus implicit cost. Both are included in that, and that is exactly your economic cost also. So what is the other name of cost? That is economic cost. Economic cost is equal to explicit plus implicit cost. What are economic profits? Total revenue minus economic cost is economic profits, and accounting profit is something else over here, is equal to total revenue minus total explicit cost. Why? Because in your accounting cost only explicit costs are involved. You don't include your implicit cost, and that's why economic cost is a wider concept than your accounting cost. That means it includes two costs, and here only one cost is involved, only explicit cost is there. So this is the difference over here. And when you are being asked in your MCQs what is the difference between accounting and economic cost, and you will say that accounting cost includes only explicit cost, but economic cost includes explicit plus implicit cost. Okay, and it is also called generally the cost only. Opportunity cost, what is that? We have explained that it in detail. That means opportunity cost is the cost of foregone opportunities. Simply put, if I can do my business or I can be in a college as a professor. So if I am doing my business, I can't be a professor in college. That means I am giving up opportunity of being a professor in college to do my business, and that is my foregone opportunity. So what is the opportunity cost? That is cost of foregone opportunity, or the salary which I could have earned being a professor in some college. Okay, so here opportunity cost is the cost of foregone opportunities. It involves comparison between policy that was adopted and policy that was rejected. How? I had two policies, either to do my business or to be a professor. So which policy did I adopt? I adopted a policy of doing my business and rejected the policy of being at the college as a professor. So here I have forgiven, or I have given up the opportunity of being a policy number 2, that is being a professor. Or in other words, it is the cost of sacrificed alternatives that are not recorded in the book of accounts. So this is not included anywhere because you have not taken up that path. If for example you have two roads, okay, to reach some destination, that means success. You have two roads, either to do your business or to go for a job. But you have given up a job to do some business. So your business is the thing you have taken up. And what you have rejected? Your job you have rejected. So rejected thing is your opportunity. Okay, and that is not included anywhere. So opportunity cost is what? The cost of doing business is not taking up your job at college. Okay, simple here. You have two roads to anywhere or two plans. Definition according to Lethbridge, opportunity cost of a particular product is the value of the foregone alternative product that the resources used in its production could have produced. So it is just a supposition. I could have been to America, I could have done business over there, I could have been a vice chancellor of university. That could have been is your opportunity cost which you have forgiven, which you have not taken up. Very clear? Then, examples of opportunity cost. Driver can drive a taxi, a personal car, an ambulance, school van or any other vehicle, but can't drive them all at the same time. If he drives ambulance, he can't drive school van. So here, he can do only one thing. Though being a driver, he can drive so many vehicles. But how can he drive all the vehicles at the same time? So, when he will be driving ambulance, he can't drive a school van. That means he has to give up driving a school van to drive an ambulance. Okay, he can take up only one path. So the path you have not taken is your opportunity cost, and it is not included in your any accounting book. This means loss of one opportunity if he takes up another one. Importance of opportunity cost. It can be used to determine factor price. The factor of production need to be paid a price that is at least equal to what it commands for alternative use. So why is the concept of opportunity cost very important? Why? Because on the basis of that opportunity cost, we can determine price of our factor. How? See, if I can be a professor at any college and earn at least 1 lakh rupees per month, that means I should be paid at least 1 lakh rupees in some other thing. That means if I am doing my business, so per month at least I should earn 1 lakh rupees. If I am not able to earn that 1 lakh rupees even after doing business for 6 months or 1 year, that means I am at loss and I may leave my business or quit my business to join some college as a professor. Okay, I may be earning more than 1 lakh rupees in college. That means it helps in determining your price. Okay, then if the factor price is less than factor opportunity cost, the factor will quit and get employed in the better paying alternative. If, for example, I am not getting good amount of profits in my business, I will quit my business, I will shut down my business, or just end up my business and go for some job. So it happens because if you are not getting that amount, you can switch your jobs. The concept of opportunity cost is also applicable to public expenditure. For the economy as a whole, to increase defense budget, civilian benefits have to be foregone or sacrificed. See, defense is really very important and expenditure is limited. See, money is always scarce in comparison to expenditure alternative uses which you can go through. That means to enhance the defense of your economy or country, you have to forego some or you have to sacrifice certain civilian benefits. Then recap, cost we have discussed. What is cost? The cost function is equal to your C is equal to function of your quantity. Then cost is equal to explicit cost plus implicit cost. And accounting or actual cost we have discussed. Economic cost also we have discussed, and opportunity cost have been discussed. In this video, we will discuss up till this only, and thereafter other costs, other type of costs will be discussed in our second part of this video. So thank you so much for watching. Take care. God bless you, and thanks for subscribing and liking our videos. Thank you so much. Take care. God bless you.